Hello and welcome. In previous video we saw the structure of Indian money market. In this video we will going to see the bills market and its types. So let's get started. So first, what is meant by the bills market? See, bill market is nothing but the market of the short-term delivery, generally vary between 3 months to the period of maturity. But before understanding the nature of this market, you have to understand the meaning of bills. I hope that you have studied it in your FY. But just to remind you, I will say that the bill is nothing but a written agreement between two or three parties. So bill stands for the promise made by the drawer to the drawee. Okay. So or the borrower to the creator, but it in a written form only. So this is was all about the bill. So now to proceed further, so what are the types of the bills? So I've taken the three types of bills here, but other than this, there are a few types are also there. That is certificate of deposits. This is one of the kind of bill. But here we'll study only three bills: bills of exchange, promissory note, and the treasury bill. These all are the negotiable instruments also. But negotiable instruments necessarily doesn't mean that they are the type of the bills market, but all these bills are the negotiable instruments. So first let's understand the meaning of bills of exchange. A bill of exchange is a written order used by primarily in the international or trade that binds one party to pay a fixed sum of money to another party on demand or at a predetermined rate. See, a bill of exchange generally acts in a international trade or the international market. To give an example, let's take a two traders, take two traders from USA and one from the India. So the person in India sitting here, he wants to pay some amount of money to the person sitting in the USA, but he will pay that money in future at the future date at a predetermined time period. Okay, so he will issue a bill of exchange to the person in the USA, and he will ask him to encash his bill after that date. Okay, from the bank he mentioned on that bill. Okay, so the person in the USA will encash that bill that let's say after the 15 days of the bill he deposited with his disposal, so that bill will be encashed after the 15 days. Okay, so the bill of exchange works accordingly. So it's a written order. It often includes three parties: the drawer, the drawee, and the payee. In our case, the person sitting in the USA was the drawee. The person sitting in India is a drawer, and the bank which will pay this amount to the person is the pay bank. Okay, so basically it's a contract between all parties, that the all parties acts together in a one momentum, and one party promise to pay certain sum of money to the another party on the behalf of the bank, which is the pay bank in our case. Okay, so this was all about the bill of exchange. To proceed further, let's take example of promissory note. Promissory note is also the negotiable instrument. Promissory notes are nothing but the promise. Okay, so but it is a written promise. Nowadays verbal promise aren't fetch any value, but the written promise does. Okay, so promissory note is a financial instrument that contains a written promise by one party to pay another party but a definite sum of money either on demand or at a specified future date. See, promissory notes is nothing but one party promises to pay certain sum of money to another party. It's a written order, it's a written agreement, and it's a negotiable instrument also. Now I'm using this word negotiable instrument. But what is the meaning of negotiable instrument? See, you can negotiate on the basis of these agreements or these papers. Let's say you have to pay certain sum of money to another person, but you don't have that money now, but you have the promissory note. So you can negotiate based upon that promissory note with that person, you can ask him to accept this promissory note as a mortgage. Okay, so a promissory note typically contains all the terms pertaining to the indebtedness, such as principal amount, interest rate, maturity date, date and place of issuance, and the issuer's signature. So promissory note also contains this kind of technical terms there. Uh, Party A, B, and C. Generally, in promissory note, only two parties are involved: Party A and Party B. Okay, so only drawer and drawee are involved, unlike the bill of exchange where three parties were involved. So this is all about the promissory note. You can read it in your textbook also. So treasury bills. Now, what is my treasury bill and why this treasury bill are floated in the market? See, it's a government security provided by the government of India to meet the short-term financial needs. Government always needs some amount of money to finance its day-to-day activities or to its valuable projects. We all know that government always run out of money, and to finance its needs, government floats this kind of bills into the market. These bills are also floated by the RBI, that is the Reserve Bank of India, to perform its open market operations, that is known as the OMO. Here I have given the example of OMO. So to just give you the highlight here, OMO. Okay, so open market operations are nothing but the Reserve Bank's tools to stabilize the economy by using this kind of treasury bills, interest rate policies, and the SLR, CRR kind of things. See, whenever government needs the money, government flushes this kind of treasury bills into the market. See, let's take an example. Government need 500 crores of money, 500 crores of money to finance its road project. Okay, now government don't have that money at its disposal. So what will they do? They'll float treasury bills worth of 500 crores with the face value of 1,000 rupees. Okay, so that 1,000 rupees face value will fetch 500 crores for the government, and the person who is investing in the treasury bill will be accepting that treasury bill as a, if he is doing the investment, and he'll earn some interest rate based upon that investment. Okay, so we call it the G6 or the G securities. Okay, so treasury bills are nothing but the investment for the common people. In the it also finance the needs of the government also. In case of RBI, whenever there is an inflationary situation in the economy, RBI floats this kind of treasury bill into the economy to uh, to minimize the portion of money from the market, and to say that yes, inflation is going, we are doing something to tackle the inflation. So RBI will flood this kind of treasury bill into the market, because whenever there is a money into the market, that money will be generating the inflationary pressure upon the economy. And we know all that inflation is a function of money, and when we want to tackle the inflation, we have to sort this kind of thing where the money will be taken out of the economy, and these treasury bills are the way to do that. Okay, so the vice versa, whenever there is a deflationary phase into the economy, RBI will take these treasury bills back from those people with to whom these treasury bills were awarded, and then the money will be floated into the economy. So these are the very logical things to do, but they have the great impact upon the economy also. I hope you have understood this treasury bills concept. So this was all about this lecture. Next topic to be covered is the institutions in the money market, and then we'll be studying the deficiencies and the reforms in the money market also. Till then, take necessary precautions, stay healthy, stay safe. Bye bye.